let's talk. Let's do what we got to do, then we can talk football
Okay, excellent.
because there's a lot to do. But how are you, Lawrence? Good to see you
I'm
again.
good, thank you. Nice to see you as well. Happy New Year.
Yeah, good. Happy New Year, and good to see you, Greg. I was trying to get back and doing all these always in person, and Danny, my producer, reached out. He's like, "Dude, have you read this thread?" I was like, "No," and he sent it to me, and he's like, "You've got to do a show about this." I was like, "I can't fly out tomorrow." He's like, "Do it remotely." He said, "Get Greg on, get Lawrence on, talk about this." I was
Yeah,
like, "Okay," so here we are.
it's epic stuff. Right?
Yeah, I mean, it's like I don't know how to read it all. Right, thinking of the listeners, we're going to go with the listeners first. I always get you to do this, Greg. I know it's a bit annoying, but uh, we're going to go through like the craziness that happened last week. Can you just do the basics again? Can you explain the role of the bond market and how it's kind of changed over this last 2 years?
Certainly. Well, thanks for having me, Peter, and Lawrence or Larry. Great to see you again. I'm looking forward to this podcast. I think we're going to have a good one. But yeah, so here's, gentlemen and ladies, essentially what is a bond? It's a contract that pays a series of coupons over the life of the contract, typically semi-annual coupons. And that contract is set at a price of 100 cents on the dollar or par at the outset. But because of interest rates, which are impacted by things like inflation expectations or credit quality concerns, the price of that bond will change over the life of the contract. It doesn't mean you don't get your $100 back at maturity. What it does mean is that if the coupon is lower than the prevailing yield in the market, the price of the bond falls to compensate for new buyers of the bond that get their return at maturity, which is if you buy something, for example, at 97% of par, at maturity, it's worth 100% of par, provided there's no default. And accordingly, your yield on that instrument changes so that it's different from the coupon on the contract. When a bond is issued, that coupon generally reflects the prevailing market yield. And that's why a 1.75% US 10-year will be issued at the current price of par. But let's say the price of that, the yield in the markets change so that the 10-year starts to yield 2.75%. The price of your bond will fall by about 8% of its face value, so that the $92 over time makes up for the loss in the coupon, the below market coupon. If everything makes sense from that basis, remember this: when interest rates go up, bond prices go down, and the reverse is true. When interest rates go down, bond prices go up.
But interest rates have been going down and bond prices have been going down.
Interest rates lately, over 40 years, have been going down from a level of 14% when I first started trading bonds in the 1980s. The 10-year US Treasury yield was 14%, and it went down to as low as under 1%. But now, the 10-year yields 1.75%, which means any bond that was issued with a 1% coupon has incurred a mark-to-market loss, right? Because the 1% coupon is too low to compensate those other buyers that could buy bonds at a 1.75% yield. So that's how the market continually reprices, Peter, because every single day, the level of interest rates changes, again, due to, for example, today, we had an inflation number which was 7% year over year. That's 7%.
40-year high.
Well, that's 7% inflation. If you believe that to be the correct inflation number, and we can get into that argument, that means that if you buy a bond with a 1.75% yield and inflation is 7%, you're actually earning negative 5.3% in what's called real terms, right? You're losing money because of inflation by owning a bond contract that only pays you 1.75%.
Right. Okay. One more question, then I've got something for you, Lawrence. What do bond prices tell you about what's going on in the market? Like, what do they tell you about risk?
Well, let's assume there was no Fed purchasing of historically $120 billion of bonds a month. Open market interest rates, where there's no elephant in the room, is the basis for setting everything from risk return metrics in the equity market, because the proverbial risk-free rate is defined as the US Treasury yield curve. Now, it's not truly risk-free, but if you read your economics textbooks, they always say the risk-free rate of return. The US Treasury is a very solid credit. It typically sets the base level of return requirements amongst all other asset classes. So equities, since they are more risky than debt, require higher returns than what you can earn in open market free treasury markets. I will go on record as saying the current markets are not free. There is manipulated rates because of the Fed purchasing a bunch of bonds. There's manipulated rates because of yield curve control in various countries. So all of this goes into setting the base return that's required on the quintessential risk-free asset, which is typically the central bank obligations of a various country. You get negative yielding bonds in the UK, or sorry, in Europe. We talked about that on your last show. That makes no sense to me. A bond then, when it has a negative yield, implies that it's not actually an asset or an investment. It's a liability because you're guaranteed to lose money. Can't explain it. Never thought in my lifetime I'd experience negative yielding bonds. But these are some of the shenanigans that are taking place in the markets today because of central bank interference.
And so, Lawrence, what's the role of the Fed in all of this? Like, how much influence do they have over rates, or how much influence do they have over this?
Well, a lot. I mean, because they set rates and they jawbone and they create expectations. I mean, let me just highlight. Greg did a really excellent summary there of what's going on, and I'd like to just put a couple of exclamation points around it. I mean, the last time inflation was where it is today, which was back in 1982, the 10-year yield was 14%. The 10-year yield today is 1.75%, which is up enormously from the 1.5 that it was at the end of the year. So it's up 17% in a week and a half, right? And the fact of the matter is the negative. I mean, I think people listening should just understand how far outside the boundaries of normality and how outrageous these prices are. Because literally, if you buy a bond today with a negative real yield of 5.3, as Greg said, and you hold it for 10 years, and inflation stays the same. And that's, of course, an assumption that everyone has to make their own determination what they think will happen with inflation. Let's say inflation stays the same, doesn't get worse, doesn't get better. You're going to lose half your purchasing power over that 10 years, more than half of your. I mean, it's outrageous. It's absolutely outrageous. And there's no doubt in my mind that if the Fed, I mean, part of the way we got to these low rates is the Fed made it very clear, and they created what I call the Fed put, or what we all call the Fed put, which is to say that they've said they can't tolerate high interest rates in a weak economy. They want to have continual growth. And therefore, they've basically said, if rates go up, we are going to intervene. We are going to buy. We are going to do quantitative easing. And that has manipulated the price, as Greg pointed out. And that manipulation, is part of the reason why people were willing to pay these rates, because they could never go the other way because they, quote unquote, knew that the Fed had their back. And what's changing right now that I think is so fascinating to watch is that it's becoming clear, the market's starting to think, hang on a second, maybe they don't have my back. maybe there's an issue here. And, and I think that's because I think even the Fed has been surprised by just how hot these inflation numbers are. And I personally, I don't know how Greg feels about this, but I personally don't see them getting any better anytime soon. I think they're very far behind the curve. And, I was reading some things this morning talking about how, in fact, Jim Bianco, the tweet we were originally referring to that got this whole conversation started, had an interesting comment on his Twitter feed that said that he was hearing that the Biden administration was asking the Fed and saying, hey, we got to get this inflation thing under control or we're going to get creamed in the midterms, coming up in November 22. So, the Fed has been talking tough, and they might, and there are a lot of us who think, well, they can't talk tough for long, they're going to blow things up. Now they put in a bunch of swap lines, they've done a bunch of other things to kind of hide it. Fed guy on Twitter has a good analysis of that. They might actually be able to follow through on some of this tough talk. And
What's a swap line?
A swap line?
Yeah.
The Fed basically, so the Fed is controlling the supply of dollars and the supply of bonds and the flows of funds. And part of this goes to the dollar milkshake theory that Brent Santiago so eloquently describes. Part of this goes to the world is short dollars because of Triffin's dilemma. All debt is dollar denominated debt. And so everybody, when they want to pay back debt, they need to raise dollars. And so that's why there's naturally a bid for the dollar, even though I kind of chuckled a little bit when Greg said the dollar was a risk-free security, or the U.S. Treasury bond was a risk-free security. Because one could argue that ultimately, if you really look through all the noise, it's not. I mean, look at the condition of the U.S. federal government. But the point is, for the sake of argument, yes, it's risk-free because they can always print more. As Greenspan said, they will never nominally default because they can always print more money. And so what happens is when you have one of these crises, when like we had in March of 2020 or like we had in 2008, when things start to go pear-shaped and the markets start to get disrupted, everybody needs dollars. And that's why they have to print like crazy. And that the part of the way they do that is they put in swap lines, because a lot of the people who need dollars are in Europe or in part of the euro dollar market, and they can't get quick access to dollars. And so, when you're running a big Ponzi scheme that's based on continual dollar creation, and you threaten to take away the future creation, somebody looks around the table and goes, hang on a second, the music's stopping, I'd like a chair, give me a chair. And that chair means having access to dollars. But again, to have that access, the Fed's got to be willing to print them. And the Fed's saying they're not printing them. So all of this goes to the exquisite dilemma that the Fed has. That is, they're just horribly trapped. They cannot move. To the degree they tighten, people, it instantly shows up in the bond market, as Greg has just alluded to.
Well, I think you're right about the Biden administration. I think they're going to get creamed anyway.
Well, that may be so, but that's a different matter. The point is that the bond market is reacting very quickly and aggressively to what the Fed is saying. And of course, that may force a Fed reversal at some point in time. I mean, we all know there's a Fed put, and the question then becomes, what's the strike price, right? I mean, does the 10-year have to go to 2? I mean, it's at 1.7. Where is it now, Greg? 1.75, something like that?
1.75, yeah.
Yeah, I mean, does it have to go to 2, 2.5, 3? I mean, that kind of an interest rate environment would be pretty expensive for a lot of people. And we used to think the Fed put was tied to the stock market, right? The stock market needs to have a big correction, and it probably to a degree is. But again, they realize they have a legitimate inflation problem, and so they're trying to address it. The issue is that by addressing the inflation problem, they may be creating another problem, which is a dollar shortage problem. And it's something else will blow up. So they push in one area, but another area blows up, is what I'm trying to allude to.
Well, it sounds like we're going to have some pain somewhere.
Greg, what do you think?
In fact, you know what, the reality, yes, you should in an efficient market, Peter, but going back to Lawrence's point, the original Greenspan put was when the equity market fell by 20%, right? The Fed had your back. They would come in and they would ease and rescue equity markets. My personal opinion is that number is probably closer to 10% right now. A 10% fall in the equity markets would cause a return of quantitative easing. But here's the real thing, and Lawrence alluded to this. When the US dollar strengthens because of things like increased interest rates in the United States, which make the United States a more attractive place to invest than, let's say, Europe, that strengthening of the US dollar causes emerging markets to get creamed. And eventually the creaming in the emerging markets finds its way back to the S&P, because ultimately the contagion permeates and circulates around the globe until everybody says, you know what, the S&P has to come down as well, because hedge funds out there that are getting destroyed in South America, for example, might turn around and say, I'm starting to short US equities. So this is how everything's interconnected, but it starts with a strong dollar. It's my personal opinion that the Fed is painted into a box, that any talk of meaningful tightening is nothing more than virtue signaling, if you will. There is no way, and let's go back to this. Lawrence pointed out the last time posted inflation was this high, using the original CPI formula in 1980, US 10-year treasuries were double-digit yields, which means bond prices at the current levels, if we were to reach double-digit yields, 10-year US bonds would fall by over 40%. Can you imagine losing 40% of a risk-free asset called the US Treasury? Oh my God, no. And that's only because of inflation. What happens, Lawrence, I postulate, when people understand that the USA really can default on their debt and all of a sudden start adding in a premium for credit concerns? This could turn into an absolute collapse. Now, the Fed doesn't want that to happen. I don't want it to happen. I will give advice that anybody owning fixed income securities right now is likely picking up nickels in front of a steamroller. They should not be invested in this risk-free asset, because there is tremendous risk in these assets, as Jim Bianco pointed out. Last week, the long bond, which is the 30-year Treasury bond, which yields 2%, lost 10% of its value. In other words, it lost 5 years worth of coupon return in 1 week. That's not very safe. I don't know who you have to be to call that safe, but in my life, I don't call that a safe investment or a safe asset.
And actually, referring to that exact tweet, it lost, when you take both the interest rate and the principal, it lost 9% of its value. Okay, and that was the worst 1 week return in the 49-year recorded history of that bond. So whenever I see a financial event that hasn't happened in 49 years, I immediately say to myself, that's meaningful. Something's going on here. So,
it all happens, Lawrence, because
go ahead.
It happens when interest rates have come from 14% down to close to zero in the USA, under 1%. And a bond is a contract, ladies and gentlemen, as I've said. And this contract, there's no subjectivity to it. Once you sign that contract, it is fixed. That is why they call it fixed income. And once that coupon is fixed, if that coupon is not in the realm of what markets should be yielding, the price of the bond has to go down, because the discretionary buyer has the option of buying any bond in a slew of treasury securities that will reflect open market yields and not the coupon on the bond. So it is the world's biggest market. There are times, and I'm talking about debt, total global debt is the world's biggest financial asset, but it's really misunderstood by so many people. And why is that? Because literally we have lived in a bond bull market for the last 40 years, because in 1980, Paul Volcker, who was at the time head of the Fed, was fighting inflation, and he raised short-term interest rates to 18% to fight inflation. The current Fed is not going to do that. They can't possibly. It would cause the debt balloon to explode. So they're going to try and massage things or whatever, right, Lawrence? They'll talk a good game. Let's see what they can actually do.
I think the important thing to understand here is the Fed thinks they're dealing with a thermostat that they can just turn up and turn down, and everything's going to be fine. And there's no possibility of a big event occurring. And what I would submit is that they're dealing more with an on-off switch of a nuclear reactor. And if they get it wrong, the damn thing's going to blow up. And that's why you've absolutely got to have a CDS on these sovereign bonds and sovereign currencies, because at some point, I mean, it's horrifying to me to watch what these people are doing. It's absolutely horrifying. I really think they're in deeply, deeply over their head, and they think they can keep pulling it back from the brink. But if this one, I mean, at some point, this thing could break, and if it does break and it breaks hard enough, they're going to have to print until their eyes bleed, and everyone's going to see it. I mean, we just saw the Fed balance sheet go from 3.7 trillion to 8.8 trillion or whatever it is. I mean, what's the next one going to be? We're going to go from 8 to 24, then we're going to go from 24 to 100. I mean, at what point do people go, Jesus, they can't stop? They just literally can't stop. You can't taper a Ponzi. You have to print, and you have to print in increasing quantities. And because you have to print in increasing quantities, I mean, we all know Gresham's law. We all know what happened in Weimar. There comes a point where everybody knows, holy cannoli, these currencies have no value, none, zero. Get me out of here. Give me something else. Give me a house. Give me a car. Give me some food. Give me some guns. Give me some Bitcoin. Give me some gold. Give me some silver. Whatever. Give me something that's not this promise. Give me some liquor. Right.
Give me some Eagle Rare Kentucky bourbon. This is what
That
I'm
looks
having.
pretty good. That's
I'm
pretty
getting
good.
through it
although
now.
Yeah.
You got me drinking, Lawrence.
But give me something that doesn't represent a claim that's run by a government that's completely, utterly devoid of morals and out of control. And it's got idiots sitting at the top of the Federal Reserve. I mean, these people are really stupid.
What actually happened last week, Greg? What was because Danny forwarded me Bianca, what's it, Bianca research thread.
James Bianco, yeah.
And he forwarded me, just so people are listening, what actually happened? Explain to them what happened.
Basically, well, at start of the year is always when you reevaluate. So it didn't hurt that it was the beginning of the first quarter and people have to set out a investment strategy for the year, likely. But what happens is people realize, much like Lawrence is saying, does it make sense that I own this fixed income instrument that yields 1.75% when inflation is running as hot as it has in the last 25 years, right? People will intrinsically look at themselves and they better say, why am I signed up for a contract or invested in a contract where I am guaranteed to lose money on a real basis, which means after subtracting out inflation? My second derivative to that is the $100 you lend the Treasury today for a period of 10 years, they may well, not certain, but highly probable, pay you back that $100 in 10 years. But what is the value of that $100 in 10 years, right, Lawrence? It's substantially lower than it is in today at time zero. So a bond contract is a bunch of buyers and sellers, the buyers being the lenders to the US Treasury or any other corporation. They look at themselves and say, does this contract make sense in the context of inflation and credit concerns? Lawrence mentioned credit default swaps. Without getting too granular, the probability of default by the US Treasury is low, but it is not zero. And you can just get an approximation of the implied probability of default by looking at something called the credit default swap market. Very simply, people are waking up to the fact that bonds may be far more risky than they've been led to believe over the last 40 years. So when you have sellers, because they say the US dollar shitcoin, right? So, but if you have sellers, that outpace buyers, the price goes down. And when the price goes down, I mentioned, yields go up. So while it wasn't a large move up in yields, the fact that a 30-year bond has something called a very long duration. It's a mathematical calculation. It's actually the first derivative of price. That first derivative of price on a 30-year bond is approximately 20 years, which means for every 1% increase in yields in the 30-year, the bond will lose $20 in price. Holy moly. It's only $100 to start with. And the yield only went up. So last week it lost 10%, right? The price was, 9.83 as Lawrence pointed out. Let's use 10. That means very simply that long yields only increased by 50 basis points or 0.5%. And yet the price of the bond fell by $10. Okay, it's only bond math. Don't get too confused. Bond math is very simple stuff. If you've done it for a history, it's a pricing mechanism. The longer the duration or the longer the maturity of the bond, the bigger the price change is for a given change in interest rates. So the long bond got smoked by 10%, but short bonds, 1 to 3 year bonds, may have lost, 25 cents to as much as 55 cents sort of thing. Really not material in the short end of the curve, but in a yield curve that stretches out to 30 years, boy, that's where they get crushed in the long end.
And Peter, to further answer your question, what made it happen now also is the fact that the Fed minutes came out, and the minutes were more bearish, hawkish, I think, than people expected. I mean, and there's growing awareness that the Fed is going to, for a while, talk tough and perhaps even act tough, in spite of the risks of blowing up the market. They need to, because they really need to try to put some cap on the inflation problem, and they know they've got a real problem.
So Lawrence, I mean, you say these people are crooks and idiots, and I agree with you, and I feel assured that you're right. But what could they do? I mean, the big issue is that we're not allowing a correction to happen. Do we just need a market correction?
Well, yeah, I mean, we don't really have markets, so so it's hard to kind of say you need a correction, something you don't really even have. But I think I think Stein's law applies. If something can't go on forever, it's going to end. I mean, you cannot continue to you can't taper this Ponzi. It's either got to continue growing until it becomes hyperinflation, or it's going to collapse because it's way out over its skis, and there's just not going to be enough money feeding the system. They're obviously going to try and walk some path between those two, and here's the best case scenario for them, and I'm guessing what they're trying to aim for. They're trying to aim for high inflation, medium to high inflation, not over 10%, but greater than 5%, and they're praying that the bond market hangs together, and they'll push rates up to 1 or 2 or 3%. And so what they'll then have is they'll have a nice negative real rate of 3 or 4%. If they can let that go on for 5, 6, 7, maybe 10 years, then the debt to GDP and GDP doesn't fall apart, then the debt to GDP ratio will get somewhat normal, and our system won't blow up. That's what they're aiming for. Whether they're able to achieve that or not, I'd give it low odds that they can pull that off, just because of all the derivatives out there, all the leverage in the system, and the awareness. One thing that's going on here, Greg pointed it out, we have had 40 years of deflation. I mean, think about it logically. Everyone can look at the inflation rate today and say it's 7%. Everyone can look at the bond and say I'm getting 1.5%. Okay, I'm losing 5.5%. That's a shitty deal. Everyone knows that. Why is anyone willing to hold that bond? Because they think inflation's not going to come back down. The consensus today amongst a lot of people on Wall Street and in the investment management business, wrongly so, is that the inflation is somewhat transitory and will eventually come down when COVID subsides and the supply chain problems subside. That's the consensus, okay? And they're wrong, in my opinion. And the reason that is the consensus is they're doing what all investors have done since the beginning of time, which is you invest looking in the rearview mirror. We've had 40 years of deflation, and there are a lot of deflationary forces. Technology is deflationary. The China price was deflationary. Demographics are deflationary. Hell, even debt's deflationary. So there are a lot of reasons why we could have deflation. I mean, Lacey Hunt's not an idiot. But, one would also see that we've kind of turned the corner on that trend, in my opinion. And we've let the inflation out of the bag. And once you do that, it's hard to put it back. It's extremely hard to put it back. And that's the lesson of the 70s. And so even though they were increasing rates during the 70s, inflation was roaring. And I think it's going to roar here again. And so I think the people who are worst positioned today in the investment universe own bonds. And then, ultimately, I don't think equities will do well either. But at least equities represent a claim on a business that may be able to pass along price increases. Bonds are just bonds. I mean, how Greg rants about this all the time. I totally agree with him. How anybody in any investment management professional could own a bond, it's just beyond me. Given what's going on in the world, it's like it's so far out there. It's absurd. It's completely absurd.
I think I asked Greg this question last time I was here, but like, are US bonds now essentially junk bonds?
Not yet, but here's the truth. Firstly, if we measured true inflation using the original formula for CPI,
where we at 15?
Correct. So 7 is horrendous, but 15, which may be closer to the truth, makes things even more ridiculous. What it requires, first of all, there are investment policy guidelines that are set so that that many professional investors and institutions have to own bonds because that's what their investment policy mix is. But as people over time realize this might get foolish, surely they're going to think outside the box and say, I'm going to adjust my investment policy guidelines so that I don't have to own 40% of my assets, for example, in bonds. I use 40% from the 60-40 traditional asset mix with 60% equities, 40% bonds. But that takes time, Peter. Over time, though, there will be net sellers of bonds. I'm highly convinced of it. And a net selling of bonds means if the Fed doesn't step in and buy them, interest rates go up and cause havoc in the market, disrupt mortgage rates, for example, disrupt high yield bond rates. But as junk goes, the USA is the best crack house on a crack street, okay? The other countries are in very, very bad shape before the USA. So my home country of Canada is in big trouble. We are not a high yield borrower yet, but I promise you that Canada will fail 10 years before the United States fails.
Greg,
Canada will be the first G7. Pardon me?
Just let me jump in there quickly. Are other countries' bonds struggling independently because of their own
credit quality?
No. I mean their own factors that are happening within that country, or is there a contagion? But is there a contagion effect from U.S. bonds struggling there? But is there a contagion as well? There is, yeah.
There has to be. So look. They have the countries called the Fragile Five. Okay, countries like South Africa. Countries like Russia, these are fragile countries that can collapse because of their own economic scenarios that are less rosy than the United States, things that cause people to charge a premium on those bonds to reward them for the risk. Look, in my career, Argentina, which is a G20 nation, has defaulted on their debt 4 times. 4. Mm-hmm. Like, think about this. And now the good thing is Argentina, Jack Mallers is doing everything he can to bring Bitcoin to Argentina. But think of it for 1 second. Who in their right mind buys a 30-year bond of Argentina when in my life, no 30-year bond has ever been issued and matured in Argentina? Well, there's lots of other countries that are in way worse shape than Argentina. Argentina's a G20. Canada's a G7, but we're hanging on there by a thread. Listen, if it wasn't for the European Central Bank, Italy, France, Portugal, all the former pigs, so Portugal, Italy, Greece, and Spain, they'd all be up there defaulting before Canada, but they have European Central Bank backstop support. It is ugly in bond land in terms of earning return for the risk. And we joked about this the last time I was on your show. As much as Peter Schiff and I don't get along, I do agree with him on one thing. He called bonds return-free risk, not risk-free return, but return-free risk. So shout out to Mr. Schiff. Yes, bonds are return-free risk. I'm giving him that one. Yeah, great call.
Who's getting screwed here? Is it the pensioners?
Absolutely. If you are a part of a, you think about the guys, blue collar Bitcoin boys in Chicago. They're a bunch of first responders, firefighters, and policemen and women who are pushing their investment policy committee to remove bonds or lighten the weighting of their bond allocation and incorporate Bitcoin. It takes time, Peter, but it happens and it can change. And then once a big fund like CalPERS changes their allocation, so do a whole bunch of other funds like the Indiana State Pension Fund and the firefighters of Houston, etc. So everything trickles down. The biggest problem here is anybody who has a bond allocation is penalizing their pension and their future returns because those bonds are not paying you for the risk that your pension fund manager is taking. That's not good. I hope that it changes because it's not fair for the pensioners. But at the end of the day, it takes time to change.
Lawrence, who else is at risk here? I mean, we've talked about the pensioners there. Who else is at risk here? What kind of assets are risky assets to be holding right now?
Well, any bondholders. I mean, I've talked to people who go to traditional financial planners. Well, I mean, the model used to be, or take 100 minus your age, and that's your equity allocation, and you have the balance in bonds. I mean, and I know wealthy people who have a lot of money in bonds, and they're just going to have their wealth is just going to melt away. I mean, it really is. So yeah, it tends to be older people because older people own more bonds than equities. But I think the pensioners are, a big place that's going to get hurt. It's funny though. I mean, to some extent, even all these parties are getting crowded out because the Fed is one of the biggest holders of the bonds. I mean, we're buying our own paper, and by the way, that's the beginning of the end, right? I mean, when you can't even sell your debt, and you basically have to sell it to yourself. I mean, that's the definition of kind of a Ponzi. And you print money to sell it, or you print money to buy it. Well, gosh, where's the real value? I mean, I mean, once again, they can pay, these bonds will not default because they have a printing press. They can print as much money as is necessary to make sure you get paid the money in nominal terms. The question is, what will the money buy you? That's the question, and that's the issue. And, it's the Hemingway quote. I mean, slowly and then all at once. These bonds are losing value. And as people come to see that they're losing value, I mean, I've often said that yield curve control could lead to the entire bond market saying, sold to you, Fed. I mean, think about it. Think about it. I mean, I just don't get it. Why would you buy a 10-year obligation at 1.5 when inflation's running at 7? I mean, it's so crazy upside down as to be almost insane. And so I think that there's going to come a time. I mean, people do it out of tradition, and they do it because they're looking backwards, and they do it because they have mandates, they have to do it. And there are a lot of reasons why people do it. But slowly but surely, they're going to do it less, especially if the 7% persists or grows. And as that occurs, the Fed's going to be faced with a choice: either let interest rates go up, and then croak the stock market and the economy, and they might do that, or intervene and buy more bonds with what? Certainly not with savings. They're already running a 40% deficit. Tax revenues. I mean, it's amazing. We basically we spend 6 billion and we only collect 3.5 or something. They're gonna do it with printed money, and again, a crack up boom, a failure of a currency, hyperinflation. It all occurs when enough people become aware that the policy is and has to be to debase the currency to get out of this problem. I mean, there's no going back. We can't have a Paul Volcker. We can't go to 20%. If we went to 20% interest rates, the entire world would go bankrupt overnight. If we went to 5% interest rates, probably the entire world would go bankrupt overnight. So that's not going to happen. So there's no going back through, establishing credibility. We're way beyond the point where we can save this system. Now it's just a matter of, are we going to die with fire, which is hyperinflation, or are we going to die with ice, which is a debt collapse and deflation? That's the only remaining question in my mind. And then the other remaining question is on what time scale? And I thought it was happening in 2008. Obviously, I was wrong. 12 years is a long time, but they're coming more rapidly now, in my opinion. And we're in a fourth turning. And my sense is that by the end of this decade, it'll be all over. and probably within the next 2 to 5 years, it'll be pretty seriously over.
What kind of shape do you think we'll be in, though?
Frankly, I think this year is going to be one hell of a year. I mean, it's really, really clear that the Fed is the naked emperor, and there are a lot of little boys now pointing at him, and so that knowledge is going to spread, and the next time gold goes through 2,000, or Bitcoin takes out 60, 68, 69. They're going to both move, and they're the fire alarms that say monetary debasement front and center. And I mean, the other thing that's going to happen, I think gasoline is going to be a big thing. Everyone knows what the price of gasoline is. And I filled up my car last night. It was $4.20. Okay. I unfortunately have a nice car, so it's premium gas. But the point is, when we start seeing $5 and $6 gas, when we start seeing $5 and $6 gas prints, you're gonna hear some people howl. And that's coming because oil's at 82 right now and it's marching. The oil chart looks fabulous. It's just marching relentlessly higher. So my opinion is, inflation is going to cook these guys. And I don't know what the hell they're going to do. I mean, I don't know why Jay Powell wanted to be reappointed. I mean, he has to be one of the dumbest men in the world. I mean, if I were in that job, I'd have gotten out of there so damn fast, your head would have spun. I'd have said, thank you very much. I'll hit the lecture circuit. I'll write a book. I'll call myself a hero. I mean, Bernanke. I mean, all those guys. I mean, when you're in that seat, he's gonna be the guy, I think, who takes the blame when this whole thing comes undone.
Now, the interesting thing with everything Larry said, I think to a person on this podcast, so none of us want this to happen, though, right, gentlemen? We do not want the system to unravel.
No.
You cannot possibly want that. So there is a solution.
Yes.
And we've talked about what that solution is. That solution is a Bitcoin standard or a parallel network that operates as your savings account, and the fiat currency is your checking account.
Right.
And you use the fiat currency for things like international trade and avoiding barter. But you don't store your value in your checking account. You store your value in your savings account. If the United States adopts the Bitcoin standard, which I think they should do, and I think they will do, then you can ensure that this network transfer rescues this horrible outcome, okay? And you can continue having a fiat global reserve currency, and the global reserve asset will be Bitcoin, not US treasuries anymore, but Bitcoin.
I completely agree.
Isn't there a risk, though, Greg, that if the equity markets drop, that Bitcoin still correlates with the equity markets, that the Bitcoin itself could drop? You don't think so?
No question it could drop, but here's the reality. And I've tried to explain this, and the best thing I can describe Bitcoin as it is credit protection on a basket of sovereigns. Lawrence brought that up. If you think of what credit protection is, it is a short credit position, meaning you are long volatility. Right now, Bitcoin trades as a short volatility asset. It trades in line with equities. Equities are a short volatility asset, but people haven't done their homework to understand what the beauty is of this instrument. It's only 13 years old. Most people don't understand what credit protection is to begin with, let alone what a long volatility asset is. But the smart guys out there, the Ray Dalios of the world, I promise you understand what a long volatility asset is. So it's a question of education. More importantly, it's a question of the big money understanding this most beautiful instrument, which will hedge all their other short volatility positions. In reality, you should own Bitcoin against the price of equities falling, but everyone trades them. Now, here's an interesting thing, and Lawrence might opine on this. Open interest in Bitcoin futures just reached all-time highs. Okay. Are there equity players out there that are short Bitcoin to hedge their long equity positions? I guarantee you they are.
Oh, absolutely.
And that's what's called hedged and wedged, okay? You are in an inverted trade and you're going to get your face ripped off when the world understands that Bitcoin is actually insurance.
Yeah.
And everyone who's short insurance now needs to not only cover their short, but actually go out there and buy insurance as well. It'll create what I called in a Bitcoin magazine article that I wrote with Seb Bunny, the gamma squeeze on the Fed put. Bitcoin is a put on the Fed put. It's the most beautiful option instrument ever designed.
Completely.
It has no theta, which means no time expiry. It is actually a long volatility asset. And the gamma squeeze on the Fed put means the Fed central bank is also going to have to be a buyer of Bitcoin.
Yeah.
It will be a face-ripping rally that will make your eyes bleed.
Yeah.
And it's coming as open interest.
Yeah. Anyone who's short Bitcoin is going to get wrecked. I mean, they're just going to get absolutely, totally, and utterly wrecked. I mean, imagine a situation where Bitcoin goes to $1 million a coin in the space of 3 or 4 months. I mean, people will get destroyed. I mean, Caitlin thinks a GSIB will go down as a result of it because people who are on the short side of the Bitcoin trade don't understand what they're doing, and if they're putting on the trade. Turn this off. If they're putting on the trade that Greg just talked about, they're insane. They're absolutely insane because there's a limited supply of this stuff and it could go discontinuous up and almost to the point where there's no offer. And, it will probably croak the financial system at some point. And so to be short it is I mean, I can't imagine anything more stupid. I really can't.
Oh man! Well, listen. Cheers. Enjoy my whiskey here. Listening about this.
I mean, look, it's going to be a rocky thing. It's going to be hard for us. I mean, how would we all react if Bitcoin were at $500,000 a coin? Quickly.
I'd be buying another car.
Well, right. I mean, it's messy. I mean,
but that car may not be safe in your driveway. Okay, so you might buy it, Peter, but it might not ever live a day to drive around the block. Okay.
Yeah,
we all might have other problems. I mean, the sad thing, and nobody wishes for the system to blow up. None of us created this system, and none of us, voted for the system. But the system is what it is, and I think it's important to understand that the Bitcoin network is just a mathematical network that doesn't give a shit, and there is no higher authority that can bail it out. And if there's more demand than supply, the price is going to reflect that. And if people have written derivatives around it, and anyone who's short it, they're going to get wrecked. Period.
So, are there any historical precedents to what we're going through right now, where you can look back and say, okay, there was a similar time here, and therefore we can kind of predict what's going to happen?
There's the difference now, Peter, is that the debt burden has never been this high, and we have never been dealing with a debt burden, not just government debt, but total global corporate and federal, provincial, every debt included, has never been this high relative to global GDP. So it is certain that currencies will debase in the absence of a crisis. But if another crisis happens, they'll just accelerate their debasement. So we want to create a parallel network. And this is I wanted to give Larry a shout out because gold bugs have known this for a long time. And this is the difference between our friend Peter Schiff and Lawrence Lepard, who basically Larry saw a better horse at the horse track and adjusted his portfolio allocation accordingly. And that's the mark of a great risk manager, okay? When the information changes, that risk manager adjusts his portfolio or her portfolio position. So a shout out to Larry for at least doing what he can to protect and fulfill his fiduciary responsibility to his unit holders. On the flip side, Peter, who admits he doesn't care, right, on our debate, I don't care about my fiduciary responsibility. I don't think I'd put a whole lot of money with Mr. Schiff. But at the end of the day, there are smart asset managers out there that are making the right portfolio changes that will reward the unit holders. And we can get to a point again where you have a network transfer. And in a network transfer, you don't just flip a switch and forget the old network and hope that the new network survives. Our new network is only 13 years old. And I don't want the USA to fail because that means Canada will have failed 10 years prior to that. And I don't want that because I have 3 kids who live in Canada. So when is it going to happen? This can go for a while as long as things are put in place as protection mechanisms. Every single
Peter,
fiat will fail. The USA will be the last, and Canada will be substantially prior to the USA failing.
Peter, your comment's a great one though. Let's go back through history because there are some similarities. There's nothing perfectly comparable to this because no Bitcoin existed pre this, but they almost lost it in the 70s. And the 70s culminated with the Hunt brothers trying to squeeze the silver market.
Mhm.
And they had it. They had there was more paper silver out there than there was real silver, and they might have put a lot of people out of business, and they might have won, but the powers that be changed the rules. They basically went to the CME and said, "We're going to change the rules. This is liquidation only. You cannot buy anymore," and that was the end of it. There was a right. But how are you going to change the rules on Bitcoin? You can't do that. You just can't do it. If everyone wants Bitcoin, the network's there. I mean, but here's a risk. I mean, they kind of did it in 1933. Okay, gold was doing it. Gold was the winning trade, and the government said, "All right, we've got to severely devalue the dollar because we've got a debt crisis going on here. All right, it's illegal to own gold. Oh, and by the way, turn all yours in. Oh, and by the way, we're going to write it down 70%. And so there have been other countries that have failed. I mean, currency failure. A credit cycle leading to enormous leverage, leading to currency failure. This is not a new thing. I mean, Dan Oliver Murmacan is in the process of writing a brilliant book about this, and I've read drafts of it. This has been going on for hundreds of years, thousands of years. I mean, John Law ran something similar to this. The French assignats were similar to this. I mean, Zimbabwe did something similar to this. Venezuela did something similar to this. I mean, printing money is an age-old political game that has been played that always ends in tears. I mean, Voltaire said it so well, fiat currencies always return their intrinsic value, zero. But, the problem is that in the interim, they happen to be what you need to use to pay for gasoline. So, getting the timing right, and Keynes had it right too. The market can be irrational longer than you can stay solvent. So you gotta time it right. But to be living in today's world and to not have some monetary insurance, I mean, we all have to admit this is the craziest monetary situation we've seen in our lifetimes. At least I know it is in my lifetime. And given that, how can you live without having monetary insurance? And to me, the obvious and clear, there are 3 really obvious and clear forms of monetary insurance: gold, silver, Bitcoin. They each have different characteristics, different positives and negatives. Bitcoin's the fastest horse, don't dispute that, but gold and silver aren't going to zero. Silver has a lot of uses, and gold's been money for 5,000 years. So they are all monetary insurance. They all beat fiat, and they all beat bonds denominated in fiat. And that's the key takeaway from my point of view.
And Lawrence, are you changing your allocation to any of these markets based on what's happening, or any of these commodities?
Well, yeah. I mean, I think I've said this in the past. I'll just be upfront with it. Everyone knows my PA is about 60% Bitcoin, 40% gold and gold stocks. Okay, the fund I manage, everyone who invested in my fund, they bought a gold stock fund meant to hedge against monetary debasement. Against some protest of some of my investors, I convinced them that they should have an allocation to Bitcoin in the fund. They said, "Fine, just don't make it too big." Okay, I took it up to about 5%, and then Bitcoin did a 5-bagger. Okay, so now it's about 25% of the fund, and if it continues to grow as a percentage, that would be great. I'm not selling any of the Bitcoin, but I haven't exited the gold business because the people who invested with me, they bought a gold stock picker fund, and I can create alpha there. The gold market does what it does, and gold stocks do what they do, but I'm also a stock picker, so that I had a stock recently that we sold, and in a market that was down 16%, we created 100% rate of return. So that's a lot of alpha. Or I'm sorry, the market was up 16% from when we did the deal to when we sold the company, and we made 100% return on the investment, and the market was up 16. So it was 85 points of alpha. So I'm paid to do that in my fund. But I can see Bitcoin. It's a faster horse. It's got a lot of beautiful characteristics. It may ultimately become, the gold thing may fade away, but that's not what my investors bought. And my first obligation is to give my investors good risk management, as Greg has said. And so, personally, I got more Bitcoin than I've got gold.
What about you, Foss? What are you doing?
If you include the company that I'm working with as a Bitcoin derivative, which I do, I'm higher than Lawrence, but is again, that's assuming that my private equity investment is truly a Bitcoin derivative. I there's arguments out there that we have some Bitcoin maxis that say you have to be all in, and they actually question me. They say, Foss, if you're such a Bitcoin bull, how come you're not all in? And I answer very succinctly, if Bitcoin goes to the price I think it's going to go to, I'm going to do just fine. And I don't have to put all my eggs in one basket because I'm highly confident, but I am not certain. And that's how I've always managed risk. This is the greatest asymmetric return opportunity I have ever seen. I'll be very clear about that.
Yeah.
But I still don't have 100% allocation to Bitcoin. It's not the way I've managed risk. And by the way, I don't need to have that allocation in order to gain the
Exactly.
upside asymmetry
That's
of the
exactly
trade
right. That's
opportunity or the investment opportunity.
I think an interesting way, and I've been saying this recently, gold is a CDS on Bitcoin failure. And I don't think Bitcoin's going to fail, but if heaven forbid Bitcoin were to fail, the next best choice would be gold. And so I try to when I'm talking to maxis who have 100% of their money in Bitcoin, and maybe they're not comfortable with the volatility. I'm like, you know what? You wouldn't be crazy to take 10% and buy some gold. You
Yeah,
wouldn't be crazy.
I
The 90% will get you where you want to be, and the 10 will help you sleep at night, and it's not going down.
do you know what? I've been thinking about that a lot because I
Yeah.
am pretty much 100%, maybe 105% Bitcoin.
Yeah.
I've been thinking about that 10% allocation to gold, or just like I've also been thinking about putting a little bit more in property.
Well, that too. Yeah, property's good.
Yeah,
The only
Oh, yeah,
issue
hard
there is they can
assets.
tax that shit. I mean, the property taxes, and as we all know, these governments are going to get more and more aggressive.
yeah. Property tax is different in the UK than the US and Canada, but yeah, I know I understand what you're saying. Well, listen, I'm glad I had a bottle of whiskey to go through this because I'm smiling away, but I'm smiling away at like some pretty apocalyptic potential outcomes. But look, it will be what it will be. I'm with you, Foss, man. I think more people need to realize like Bitcoin is the escape valve for a lot of these people. But listen, appreciate you both coming on. We've got to try and get the three of us together in person.
I look forward to that.
Yeah, anytime.
We'll make that happen.
Lawrence and I have a standing date in Boston. I actually have to pay a bet I made with a mutual friend of Larry's and mine. That I bet on as a bit of a quirk. I bet on the price of Bitcoin at a closing level. He's a gold bug, a very intelligent gold bug. I may add, not knowing him as well as Lawrence knows him. But here's the cool thing. It's not about Bitcoin versus gold. First of all, gold is still arguably $10 trillion. It's pretty small in the global pie of financial assets, which is 900 trillion US dollars. Okay. Debt of that 900 trillion, debt is 400 trillion. Get me 10% of the debt market going into Bitcoin. 10% of the debt market is $40 trillion. 40 trillion divided by 21 million. Oh my goodness, there's your $2 million price target of Bitcoin. Don't have to argue with the gold bugs. We don't have to argue with the equity guys. The debt guys are the idiots in the room, okay? If you are lending money, you are a clown, okay? You failed mathematics. Understand that Bitcoin is your appropriate new asset class. If you're going to allocate to Bitcoin, you have 0 Bitcoin, you need to get some, take it out of your bond portfolio, take it out of your bond basket and move it into Bitcoin. Get off 0, right, Peter? There's too many people in the world that still have 0 allocation to Bitcoin, and that is too dangerous.
It's not all apocalyptic. This thing will get sorted out. It really will. I mean, unfortunately, there will be some people who are naive will get hurt, but a lot of people won't. And the issues here will get sorted out. We will return to sound money, and I can see. I'm very much, in the Jeff Booth school of the world being a really great place when we get to the other side of this transition. It's just going to be bumpy. That's all. It's going to be really bumpy. but people get a couple chances at it. I mean, look, there were people at 69 thinking, hey, this shit's getting away from me. Now they got a chance. They had a chance recently to buy it at 41. And this is the case for dollar cost averaging. Just save in Bitcoin terms. In 10 years, you'll be really glad you did.
Well, listen, Foss, you let me know when this dinner date is in Boston. I'll fly out wherever I am. I'm going to come out. I need to be sat at that table.
Oh, yeah, and we'll get together with Jason Lowry too, right? We'll do that again with Jason Lowry.
Spooks are us. We'll do that. Well, listen, look.
Spooks are us. Yeah, listen, guys, thank you so much. I will.
Yeah, thanks, guys. Really enjoyed it.
I love what you both are doing for the community, and I'm so proud to be part of this community. So yeah, we'll get together in person, and I'll see you in Miami, if not before. Okay.
Yeah, we'll be
so
there.
looking forward to that.
Let's do that.
Okay, boys. Thanks you again.
Guys. Take care.
Good night.